Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we welcome back Lobo Tiggre, who's the author and publisher of The Independent Speculator. Welcome back to the show, Lobo.
Glad to be back.
Let's start with gold. Over the last few months, two very well-known investors, Ray Dalio and Paul Tudor Jones, have talked about gold and the potential for it to go a lot higher in the long run. So when these kinds of investors start to talk about gold, does that signal a shift to you, Lobo, in how the precious metals are going to be viewed going forward? And does this begin the path for more mainstream awareness of the gold and silver bull market?
Second question first. I would not say it begins the path. And I would say that it's more reactive in terms of information and input. You know, the price moved first, and these are forward-looking guys. They're making big picture analyses and pronouncements. So I'm not saying, they just jumped on the bandwagon because gold got higher. That's not what I'm saying. But it is interesting that the prices started moving before this, though. I would say in both cases, those gentlemen were not hostile to gold before. It's just interesting that they had these big picture analyses at this time. But what people really want to know is what's going to happen next. And I find it interesting that we're having this conversation at a time that gold is consolidating. It's dropped back. It's not testing recent lows, but it's testing recent support. And in that environment, you have these big pronouncements, and that does help. And I think one thing for people to remember, and it's important because people, let's say some pundits, I think, misdirect attention. You know, they want to try to calculate the correct price of gold based on mine output and supply and demand and how much jewelry fabrication there is. And I think those efforts are misguided and strongly misleading. Gold has two ways of functioning on a basic level. It often trades. It correlates very highly with commodities in general and other metals prices. It's often treated as a commodity, and that's the basis of the inverse relationship with the dollar because it's priced in dollars. It moves with other commodities. That's where this drive to try to determine the correct supply and demand and the equilibrium price comes from. But it also has another mode of functioning that takes over under times of systemic stress or times of great interest when people like these gentlemen you're referring to light a fire of interest under the price. And that is, gold is a safe haven. And when there's fear of blood in the streets and people are concerned, that has nothing to do with mine supply. There is no correct price of gold in those circumstances. It just goes where it goes. And it's really a fear barometer. So when you have luminaries like this sort of sounding the alarm and talking about paradigm shifts, right, that does matter. I don't think that determines the price of gold, but it tells you something about which driver is going to be more potent. And I think clearly with all that's going on in the painful awareness of mainstream investors that the bull has gone on for a record length of time, and the party cannot go on forever. I'm sort of mixing a lot of things in here. Sorry for that, but it is complicated, and there's no simple yes or no answer to your question. But I do think that what you brought up is very important, and I think it tells us which of the drivers is the one to keep an eye on going forward.
Yeah, very interesting. Okay, let's move on and talk about your research and analysis. I know you like to go on site visits to determine whether a stock is actually worth investing in. So let's talk about what you actually do on a site visit and what you look for. I know you've worked with Doug Casey in the past, and I remember him once saying that even though the site visit would cost you the time and the airfare, ultimately it would tell you the real story and either save you a lot of money because the reality isn't as good when you visit the site, and you wouldn't invest in a bad project, or it would make you a lot of money and the reality would live up to the promise and more. So can you talk to us about this?
Sure. Well, you basically outlined the case there. It's due diligence. And of course, every company is going to put its best foot forward. Even the straightest shooters, the most honest, guys who are just mining engineers who build their mines and they're not overly promotional, they're not going to highlight all the problems they have in their PowerPoint. Nobody does that. It's not reasonable to expect that. So you have to go and look. And of course, not everybody is the most honest, straightforward, straight shooter out there. You're going to have a bell curve along the line. So it is important, and not everybody's a crook, but they all have to put their best foot forward. They all have problems. The best mining opportunity in the world is never going to go completely without opposition or without surprises. You never know what you're going to discover. You never know if it's going to turn out to be feasible when you do discover something because of all the questions that haven't been answered yet. And you don't even know if a mine is going to be profitable when you start building it. I mean, you're basically, this is a Doug Casey quote, you're basically building a hugely expensive, very complicated chemistry plant and shoveling a bunch of dirt through it. You never know how well that's going to work out until you flip the switch and see what comes out the other end. So yes, due diligence really does matter. There's so many things that can go wrong that they're not going to highlight. And you as the buyer or as the buy-side analyst, I guess you could call me, it's incumbent on you to go out there and kick the tires and look for things. And it's not just whether they're lying or not or whatever. It's same things they might have missed. And one of my personal advantages in this is that I do speak French, I do speak Spanish, and large parts of the mineral producing world are in French-speaking Africa, Latin America, places where those languages are very useful. And I can go and speak to the locals in their language without management supervision. I will sometimes arrive before my scheduled visit or stay later and do my own due diligence on my own and find out as much as I can independently. Independent speculator, right? Get independent information to verify the story. But I will say on the plus side, sometimes you become aware of things when you're there. I remember one time I went to go visit a company in Argentina. It was the guys, it was White Knight, who had what the Lindero deposit that Fortuna Silver Mines is building right now in Argentina. And I went up there to look at that. And I became aware of Antares, I don't know if it was minerals or resources at the time that had this nearby copper gold project. And that made me aware of the quality of their work and what they were working on. And that turned out to be, I ended up recommending the other stock, and they made a huge copper discovery in Peru. It worked out to be a big win for readers. So sometimes just being there, it's like the saying, in the room, in the deal. Well, sometimes having your boots on the ground is the only way to find out something before the rest of the market knows. And that's really the bottom line here. Yes, it's due diligence. Yes, it's making sure people aren't lying to you. It's verifying. But ultimately, the goal is to know something before the rest of the market knows. And if I see, the work being done and I know that it's shoddy, I know that before the rest of the market, knows, that does come out in the end. Or if they're having, fantastic results, you see the gleam in the geologist's eye, I can get an inkling of something before the rest of the market knows. So it's very important work.
Okay, well, you've been very successful within your career and have surrounded yourself with some very smart people like Doug. So what mistakes have occurred throughout your career that have led to perhaps your biggest lessons, either as a contrarian or as a trader? And if you could begin your career again, Lobo, what would you do differently, if anything?
People have asked that, what have you learned, what are your biggest mistakes question before, but what would you do differently that's a new one on me. So instead of saying, good question, and stroking my long white beard, give me a moment to think about that. So let me start with the lessons. The biggest lesson is not one unique to me. It's the hubris lesson. I came into this in 2004, right as Doug and David Galland, his partner at the time, founded KC Research. And gold was on a tear. This is leading up to the 2008 crash and then the big rise after that to 2011. And the metals and the commodities, remember we were saying gold often syncs up with other commodities in the metals. They were coming off the cyclical low in 2001 was the bottom, late 2001 for most of them. So things went up and, something could seem like, that seems pretty interesting. And I won't say that throwing darts at the board worked or the tide lifted all ships, but it's pretty easy to pick winners in that environment. And I had a lot of winners, 10-baggers early in my career that I spotted. Not just, Doug say, hey, go research this. He did that. But, I spotted some interesting stories and so many of them worked out. And then 2008 hit and I was not prepared for how painful that would be or how low things would go. things dropped 50%, and I thought they were great deals, but they went down another 50%, and then 50% more from there. So that was a very painful lesson. And then after that, that really sorted a lot of wheat from chaff, and there were a lot of things that looked good on the way up that just didn't cut the mustard. So not one lesson, but many painful lessons there, but all related to this hubris thing and coming into the market when it's on its way up and mistaking the market's upward momentum for your own personal genius. That's more of a Rick Rule quote there. Definitely a big thing. So what could I do different? Actually, I would, if there's one thing I could do different early on, I would say that David and Doug kind of threw me in a sink or swim sort of way. And I don't want to criticize my mentors because they taught me so much and I wouldn't be where I am without them. But I do think that was a mistake. If I could do one thing, I would go back and I would push back more. I didn't want to say, hey, bosses, I don't know enough here. I need help. I need more help. I don't know what I'm doing. Right? That would sound bad. That would, but I probably should have said that. There were some early mistakes I made that a little more adult supervision would have prevented. I'll be specific. I remember when the Virginia gold takeover happened. The stock went way up, and we had a huge win. And I made the call to sell the stock, but it was early on enough, and I didn't really pay attention, or I didn't understand yet the significance of the takeover being in part for shares versus cash, and what that could do for the shares going forward. Given the takeover and the potential upside there, and that you would, if you held, you would get spin out shares and things. So I didn't fully understand the deal. And it was a mistake to just take the money and run. It wasn't a terrible mistake. People made money, right? But we could have made more money. I could have served the readers better had I better understood what I was doing. And so, if I could change one thing, it would be that I would push back and say, "Hey guys, I need more help here. Teach me more."
Very good. Okay. Let's talk about some of your favorite investing or mining books. And is there anything that you're currently reading today or recently that you could share with us? Do you have any recommendations?
I have to say, I don't have an economic geology textbook or lay book out there that I can endorse and say this will really set you up on the right path. One of these days I intend to write that book. I'm talking specifically for the investor out there. There's obviously a lot of very interesting geology books out there, and some of them do make an effort to, really popularize, Carl Saganize geology, if you will, right? Talk to the layperson and make it accessible. There's plenty like that for people who are interested in it, but and there's some even that touch on economic geology, right? Not just geology, the wonder of shiny rocks, but how you discover a mine. But really dialing in on how does an investor make money? How does somebody spot an early stage play that has the right stuff to go on and become a great discovery or a mine? I just don't see one out there that I can endorse. So I have to fall back to more investment basics. And obviously the works of Messrs. Graham and Dodd, The Intelligent Investor, is one of the books I pull off my bookshelf the most often. And even though, early on, Graham himself says that he specifically cited that mining was not an industry that his analysis, his style of security analysis was suitable to because it was just too volatile. So the classic Graham Dodd analysis doesn't even apply to the big boys, the Rio Tintos of the world, let alone the little juniors that you and I and many of the audience, like to speculate on. But despite that, a book like The Intelligent Investor is really about investor psychology. And he spends most of that book talking about what goes on in Mr. Market's head. And those lessons are just as true today as they were when he wrote them. Human nature hasn't changed. And okay, there's ETFs and all these derivatives and algos now. But at the end of the day, it's human beings pulling the trigger and setting the algos off, doing all these things. And that hasn't changed. So I probably, outside of what people like Doug and Rick have taught me, I think Ben Graham is probably one of my most important teachers.
Excellent. Okay, as we begin to wrap up, Lobo, is there anything else you'd like to talk about today? Anything else you'd like to share with our listeners?
A couple things. One is, as you and I speak, we'll see what happens when this interview goes live. But gold is in a correction and consolidation phase. I absolutely see that as an opportunity. All the things that caused gold to rise this year have not changed. They're in force. And as you say, big names are jumping on the bandwagon. I do believe that the precious metals will head higher. And I am personally putting my own money to play in that. So if I'm wrong, I will suffer alongside anybody who listens to me. But I don't think I'm wrong. I do think that's a fantastic opportunity. If it persists when your listeners hear this, I would strongly encourage them to go along and move into this space. There are other things happening. We've discussed the uranium space. There's an important potential decision or driver happening in that area in the United States that may be resolved by the time your listeners listen to this. So I would just encourage them to research what's happening in uranium when they hear this. There's also, broadly speaking, a really interesting thing that people should be paying attention to. And that is that we have this cooling global economy. We have lots of recession signals in the US. We have Germany and the EU, on the border of slipping into recession now. We have even China cooling beyond the trade war impact. So, this is bearish for lots of metals, commodities writ large. Even the industrial metals that are necessary for the new energy paradigm, the most popular metals. But at the end of the day, if there's a real supply crunch, that can trump this. And we have seen this in the palladium space. Palladium just hit a record high of $1,800 an ounce. And this is driven by industrial demand, not precious metals demand, because there is a supply issue there. At the same time, we're seeing nickel starting to edge up, and the Philippines and Indonesia are causing supply issues there. And Indonesia just slam the door on exporting raw nickel, and you'll have to process it. You'll have to smelt it there in the country. So I'm not predicting exactly what will happen. And if the economy slows down enough, all your industrial minerals are going to get hurt regardless. But if there's a genuine supply crunch, if there's just not enough of this stuff, that can actually come back and trump that. So just something to watch for. Your listeners, I think, will do well to watch for special circumstances where powerful supply crunches are causing particular metals, to buck the overall commodities trend.
Well, many thanks for your time again today, Lobo. It's always a pleasure having you on the show.
Yep, thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?